On today's episode, we are going to take a closer look at one of my favorite semiconductor companies, Nvidia, and we're going to take a closer look at what a professor deems about its valuation to kind of explain to us what's happening here, maybe explain a little bit more about who we are discussing is Billy. Good afternoon, Billy. How's it going?
Going well, Jose. I'm excited for this topic. Um, Valuation. It's a mixture of stories and numbers, which I learned from my valuation professor when I went to business school. I actually took valuation from Oswald Damodaran, who is somewhat famous in the finance and business world. He appears on CNBC a lot. They call him the dean of valuation, quote unquote. His class was fantastic. And the good news is that you don't even really have to attend NYU Business School. He publishes basically all of his class materials for free online, which he has somehow gotten permission to do. In any case, he makes extremely detailed blog posts regarding all sorts of topics from the general economy and sometimes to individual companies. I wanted to bring to attention to our viewers that he recently did a blog post on Nvidia and its valuation. Um, and Oswald Damodaran, he actually has been a shareholder of Nvidia for a while. So he would, and as we know, Nvidia has gone gangbusters this year, reaching over $1 trillion valuation. And he thought it appropriate to, in light of the AI boom and Nvidia's stock's huge rise, he was going to revalue the company and see what came out. Um, so, in his valuation framework, there are four main factors. There is revenue growth, and he usually uses a 10-year valuation model where he basically assumes a company is going to reach maturity in 10 years. So within that, there is revenue growth. There is profitability in terms of operating margins. Then there is the reinvestment rate, which is how much capital does the company have to spend in order to achieve that growth and those margins. And then finally, there is the cost of capital, which he uses the capital asset pricing model, which is a function of the risk-free rate, which uses the 10-year treasury, and then an equity risk premium, which is a premium investors are demanding for stocks, and then multiplied by the beta of the company, which is basically a function of how volatile earnings are. So let's get into each of these four assumptions that Professor Damodaran used. He actually went through a lot of detail in mapping out what he thought the AI chip industry would be in 2033, what the auto chip industry would be in 2033, which are NVIDIA's two main high growth markets. And then sort of gaming and other, he looped in as the third segment, which is sort of the traditional gaming chips, the visual chips that were the previous core markets.
Discover the world of semiconductors without getting lost in the technical jargon. My new membership offers a perfect balance for investors looking to understand this exciting market. Using my electrical engineering knowledge and experience, I will release weekly exclusive videos ranging from quick 5-minute 101s to in-depth analysis, covering not just popular chip stocks, but aiming to explore every public semiconductor. Plus, join a private community of like-minded investors. Finally, I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
And then he estimated what kind of market share he thought NVIDIA would achieve by 2033. So as you can see, he has the AI chip market absolutely booming over 20x to $325 billion from $15 billion today. But he does have NVIDIA's market share going from about 75% down to about 60% today as competitors like AMD enter the field and perhaps more custom ASIC competitors. Auto chips, he has growing 10x in 10 years. As we all know, cars are using more and more chips as they become more automated and electrified. and he has Nvidia's market share going from 3% to 15% over that time of all chips. And then he plots gaming and other, that's the traditional markets for Nvidia, growing 15% for the first 5 years, and then slowly decelerating to the terminal growth rate of 3.6% in year 10. All in all, that comes out to Nvidia's revenues growing 10x over 10 years, pretty much, from about $26 billion today to about $267 billion in 2033. So a lot of growth, but he does think Nvidia will give up some market share in the AI chip segment. Still fairly optimistic. He also, now turning to profitability, the professor actually takes the operating margin of Nvidia, but he does adjust his operating margins for tech companies in a certain way. He tends to view research and development costs as a capital investment. So he actually adjusts. So that basically boosts profits because he depreciates the last 5 years of R&D investment, and if that grows every year, you're going to have lower depreciation than you do R&D investment. But it will also increase the capital intensity of the business since you have to invest a lot in the research and development asset. Anyway, Nvidia's in a down market now, but its previous highs were about a 35% adjusted operating margin. He assumes that grows to 40% in 5 years and then sort of maintains right there. So a little bit of margin expansion over that time, but not that much. In terms of reinvestment, he takes a 1.15 sales to capital ratio. This is like working capital, CapEx, and research and development. That's actually more efficient than this current year of 0.65, but remember, we're coming out of a cyclical down year. So he's giving a little bit of the benefit of the doubt there. However, some of the best chip companies have sales to capital ratios up near 2. So this might actually be a little bit conservative on the reinvestment side here. And then finally, cost of capital, he has a very high 12.2%, which is the semiconductor industry average. As we all know, semiconductor industry can be quite cyclical and volatile, which is why it's such a high cost of capital. So he starts with that very high, but has that slowly drifting down towards a more normal 8.85% by year 10, as he believes the AI market will lower cyclicality. Then he has the company growing at a terminal rate of 3.6% in perpetuity, which is basically in line with the 10-year yield. So it gives NVIDIA a lot of benefit of the doubt, maybe a little bit conservative on the reinvestment, maybe a little conservative on margin expansion. In any case, if you go to the next slide, what does that spit out in his model?
Yeah.
It spits out. Go ahead.
Before I take a closer look, Billy, I do want to say one of the things that I feel gets underlooked for Nvidia, its automobile market because it's such a small player. But we can see here by the professor, he believes that this is probably one of the outside of AI, this is one of its biggest growth opportunities in the future.
Yep.
Maybe not in forms of total revenue, but at least in growth rate, that he does expect this to be pretty interesting. So I'm pretty interested about that because I do believe in the auto market. You have your traditional things like autonomous vehicles, but then any type of mobility. Like I do believe in the upcoming decade, which is this estimates or assumption in the upcoming decades, we will have more kind of like some form of delivery robots. If you go to cities like Austin, you already see kind of these little robots delivering food stuff, your autonomous vehicles like Waymo already working in San Francisco. So in 10 years, I don't think it's going to be a crazy future where we have a little bit more robotics kind of delivering a few more solutions out there. And obviously in the kind of industrial market as well. So I'm happy to see the auto market being a big player here. So let me just jump into the next slide now so we can continue here.
So unfortunately for NVIDIA shareholders, those assumptions actually spit out a $237.55 target price, which is a little bit more than half the company's current share price today. So obviously, if the prospect of falling by 40%, even with those pretty decent assumptions,
Hmm.
it might be enough to give in some Nvidia investors pause. Obviously, it's been nothing but bullishness and optimism right now, but you never know when sentiment might turn. However, it's not reason to panic necessarily. If you go to the next slide, you'll see what Damodaran's conclusion about this was. Okay, so first, valuation is not an exact science. All of these assumptions are subject to risk. In fact, Damodaran, when I took his class, said, I don't care if you think I will be wrong. I know I will be wrong. However, we have to model based on some assumptions to get some idea of what we're looking at here. So this is a sensitivity table on top here, which so he plots revenues, between what was it, 267 billion. So here's sensitivity. So if Nvidia can outgrow those assumptions, maybe maintain its market share in AI, or maybe grow the traditional gaming a little bit more than 15% for the next few years, or maybe if they discover some new segment for chips, they could exceed that. If they get up to the $400 billion range in 10 years, and if they can expand their operating margin to 50%, then you get a share price that's probably around where the stock is today. And also, I didn't even put in he didn't put in a sensitivity table for sales to capital ratio, which is probably where he was being a little bit conservative, as well as cost of capital, which was quite high to start out at, over 12%. So if you're using maybe a little bit lower cost of capital, maybe it's a little bit more efficient, maybe the operating margins are a little bit higher and the revenue's a little bit higher, then yeah, you can get to an intrinsic value around today's share price in the low 400s. As you can see in the lower right corner, you just have to, as an investor, you just have to understand that that's what you're anticipating. It's going to be at the more optimistic end of this range than the lower end. And so even though the good professor came out with his base case that was 40% below today's share price, in his blog post, he wrote that he only sold half of his position. Now, he said, I chose the path that splits the difference, selling half my holdings and cashing in my profits and holding the other half for the optionality that the company will find other new markets to enter in the next decade. Nvidia has a long history of investing in these new niche markets way ahead of the curve. Like a few years ago, we weren't even sure what the AI market could eventually look like, and now we're anticipating more than $300 billion 10 years from now. So who knows, there could be a new market for its chips that is not factored into this valuation. And that's part of the reason why he's still holding on to half of his shares. The value purist can argue with justification that I am acting inconsistently given my value investing philosophy, but I am a pragmatist, not a purist, and this works for me. It does open up an interesting question of whether you should continue to hold the stock in your portfolio. You would not buy at today's prices, and it is one that I will return to in a future blog post. I'm definitely going to be reading that blog post because that's an issue I have
Definitely.
a lot with. You buy a stock, it goes up a lot. Do you sell and cash out just because you wouldn't buy at today's prices? If you ever read that book, 100 Baggers about stocks that went up
Hmm.
100x, they don't go up 100x very, very quickly or in a straight line. It's a uneven path, and you have to hold for 15, 20, 30, 40 years. But if you find a winning stock, that's the type of thing that can happen. And then, of course, when you sell, unless you're in an IRA plan, you're going to have to pay capital gains taxes when you sell. That is also a factor to take in as well. So, I wanted to bring this to people's attention. I've missed out on Nvidia. I've benefited from some other AI beneficiaries, but I always thought Nvidia was a bit expensive, and this blog post did seem to back
Agree
up
with
the
yeah.
fact that I thought it was
Hmm.
expensive, but maybe not if it can continue to shoot the lights out. In any case, it may be a word of caution for anyone piling in right now, especially after the stock has run so much. You might want to think twice about that. And maybe for some that have huge gains, you may want to trim some of your profits. But I just wanted to bring this to people's attention. And if you hadn't heard of it, Aswat Damodaran, he has some great valuation templates you can actually download from his website. I would encourage people to do that. It's pretty easy to just plug in some basic assumptions and to get values to spit out. They act as great guideposts when you're buying a stock, or if you're deciding to buy a stock, or if you're deciding to sell a stock, and can, I say, help anchor some expectations. So I'll throw it back to you, Jose, for any commentary you might have.
Uh, Billy, I mean, I really did enjoy this segment. It's probably one of my favorite segments in a while. And that's that I enjoy probably every segment that we discuss here in this channel. And what I enjoy a lot is he kind of goes about it and we kind of see this valuation of the company, and at the same time he comes here and kind of goes, hey, I only sold half of my position, and if I was a purist when it comes to valuation, I most likely would have sold all my shares because of the way the valuation is. I mean, I believe this company is estimated in the next 3 years to have a revenue of only 45 to 50 billion dollars, and it's already sitting at $1 trillion. So obviously when you look at it like that, it looks crazy, but at the same time it's like I'm willing to sell half my shares because this is a company that AI came out of nowhere. What if another market comes out of nowhere and we can continue to see this growth? That's where the kind of product is for Nvidia. And maybe some investors might not see that as investing. They might just see that as maybe some form of maybe gambling to some extent, where they're gambling that, hey, the future might be some new markets that we can't think about. But the first thing that I was thinking about when we first started this, Billy, is this was assuming that in 10 years this becomes a mature player. And in my mind, I'm like, in 10 years, I can't imagine NVIDIA being mature. I can just imagine some form of new technology taking over the world,
Right.
and maybe NVIDIA being in the forefront of that technology. But I really did enjoy that. I really am going to read that blog post where he talks about companies that we wouldn't buy at today's prices. For example, NVIDIA is not a company I personally, even though it's my number one position in my portfolio, is not a company I would buy anywhere at these levels. And I wouldn't know how to react with it, right? I
Right.
always have that question: which one would I regret more? Would I regret selling some shares right now and in the future Nvidia stock going up dramatically, or would I regret not selling shares now and the stock kind of going back to reality in the future? And I do believe that's something that every investor has to go through. We see that this professor, his way of going about it is selling half, where he probably took a nice amount of profits and is still letting some more be out there just in case this grows out from here. So I really did enjoy this. It's definitely pretty interesting. I'm pretty sure the viewers enjoy this a lot. Any final thoughts, Billy, before we close out this topic?
Um, no, just if anyone wants to follow along with the professor, his blog is called Musings on Markets. Aswatdamodaran blog.blogspot.com. And he also reposts everything on Seeking Alpha sometimes, but he's usually on CNBC as well. Anyway, he's just one of my mentors, and he's very generous in making virtually all of his classes free to the public. Um, and I would highly encourage anyone interested in learning more about valuation, or if you're curious if stocks in your portfolio are undervalued or overvalued, to check out his website and his blog.
Thank you for that, Billy. I think this was a great way to end this segment. Like I mentioned, one of my favorite segments we've done in a while. So thank you again, Billy, for bringing this up. Take care, have a good day, and see you next time.